Thank you for joining us today for Lazard's update on the global small cap strategy. I'm joined today by Neal Doying, Portfolio Manager and Analyst with Lazard's global small cap team. Neal, thank you very much for joining us today on your whirlwind trip. I believe you've been in Japan and New Zealand recently, so I thank you for making the time to come in and talk to us. Global small caps is an area we've been getting quite a bit of interest in, understandably. Although if you look at the point in cycle we're at, I think if you look at what's happening in asset markets generally, there are plenty of reasons I think that professional investors are finding challenges. And I imagine global small caps is no different. Could you give us a bit of a sense in terms of what you're seeing in the asset class today and what some of those challenges are?
Sure. There are some significant headwinds in the market right now, specifically in the small cap space. One of those would be that small cap companies are actually getting larger. And what I mean by that is if you look at the index, in 2011, there were only maybe a handful of names, maybe 6 to 12 names that were above $5 billion in market cap. Now you fast forward it, last year that topped out at 30% of the index, over 250 companies that are above $5 billion in market cap. And that's largely been driven by interest in and market participation in companies that actually aren't earning a lot of money. The biotech space, early stage IT, software companies, and that's what we've seen be the main driver of that. And it's largely been driven by companies in the US and the US market. And so you've seen, larger small caps driven by investments in companies that aren't actually earning money. And then the other factor that's really been a headwind for us has been increased leverage. We traditionally look for companies that have cleaner balance sheets and thus are able to weather economic conditions and provide more defensive characteristics to your portfolio. And you've seen leverage in the market, in the US market specifically, go from 2 times net debt to EBITDA to 3 to 3.5 times. And the rest of the world is still at 2 to 2.5. The last thing we've seen in the market that is creating some concerns specifically for perhaps the U.S. market would be fuller earnings profile for U.S. companies outside of those non-earners. Profit margins are above pre-Great Financial Crisis levels in the U.S., still below outside the U.S., so offering more opportunities at companies outside the U.S.
It sounds like there's lots of challenges at the moment within the benchmark, but obviously you are finding opportunities, you are finding places to deploy investor capital. So what are some of those?
Yeah, so just a reminder, our investment approach is looking for companies with high or improving returns at attractive valuations. And we believe there's always opportunities out there. And you have to just look beyond those, look a little bit deeper or look beyond those headwinds to find those opportunities. So one example would be a company called Charles River Laboratories. And this company provides services to the biotech industry. So we wouldn't invest in the biotech companies that don't have earnings and have very high valuations. But this is a company that provides more picks and shovels, if you will, for that space. So kind of like in the gold rush in the States, gold miners really didn't make money back in the 1840s. It was the people supplying the picks and shovels and Levi Strauss jeans. This company provides genetically engineered mice and rats for early stage and discovery work at pharmacy companies, and then also provides manufacturing services and has expanded into China and is seeing good double-digit growth at a very attractive return, about 24% ROE. So that's a way for us to invest be exposed to an area we think is very exciting in the market and still maintain our investment philosophy. Another name we're invested in is a company called Americold, which is a REIT, and they invest specifically in cold storage, low temperature warehouses. And in the US, you're seeing a lot of secular growth for grocery delivery. It's still just maybe 3 to 4% penetration rate in the US versus much higher in other parts of the world. And we think as Amazon and these other players get into this space through their acquisition of Whole Foods, they're going to have more home delivery of groceries, more demand for low temperature cold storage, and it has good secular growth. And this company also has defensive characteristics with a strong dividend, prudent capital allocation policies, and so again offers us an opportunity to be in a reasonably priced company at good valuations and good returns and be defensively positioned, which we think is important at this stage of the cycle.
So despite some of the challenges, it sounds like you're finding ways and means in order to participate in some of those growth stories without having to abandon the way that you guys invest and the philosophy that you bring to bear. So it sounds interesting. Probably one of the last questions I'd just like to cover with you is that, I mean, you've been investing for over 30 years. You've been a small cap specialist for most of those. I'm sure you've seen a lot of cycles over that period of time. If you were talking to an investor who was either in the space at the moment now or perhaps looking at making investment in global small caps, what would some of the key considerations that you'd be wanting them to look at given the current environment?
Sure. The small cap space, we believe, is always attractive in terms of portfolio diversification. The small cap offers a premium to large caps over the long term, and we think that there's the ability to capture that no matter where you're at in the cycle over the long term. You can never time markets. I think it's a very difficult proposition, and your best bet is to invest and then have that as an important part of your portfolio to give you those returns and to capture those returns. And we think that active management serves you best because of these factors I talked about. And if you're a passive investor, you're exposed to a lot of these non-earners. You're exposed to this high leverage. And so if you enter an economic downturn, you're exposed to companies which are going to have a hard time weathering that because of balance sheet leverage as well as operating leverage. And so you need to be invested in companies that have managements which understand their competitive advantage, can continue to generate those high returns through an investment cycle. And that's what we think our investment approach provides.
Neal, again, really want to thank you for your time today. Thank you for joining us for today's update. If you would like any further information on Lazard's global small cap strategy or any other strategy within the Lazard suite, please go to the website at lazardassetmanagement.com.au and alternatively, please contact your business development manager. Thanks.